What's up, everybody? It is Monday, August 22nd. So, actually, I got a lot to talk about today, so let me get right to it. I'm going to start off by saying I was surprised. I'll be honest, I was surprised at the magnitude of today's stock market drop, particularly given Friday's drop. Okay, so Friday and then today down another 2.5%, like 1,000 points on the Dow in 2 days. And I'll tell you why I was surprised. First of all, this market is heavily short. I checked the CFTC commitments of traders on Friday, as I always do, and it showed that as of last Tuesday, that was August 16th, large speculative funds are net short. That means short minus longs, their net position. They're net short 600,000 contracts. That is a record. That represents notional face value 126 billion commitment to the short side. That is massive. Massive, okay? So that's number one. Number two, institutional asset managers, they're not really long. All right, they're long like a net 300,000 contracts. I mean, historically, you know, if you're in a bull market, I mean, you could see that run up to 7, 8, 900, even 1 million contracts net long. They're long like 300 something thousand. It's really nothing. Dealers are net long a record amount, and that reflects the fact that their customers are short. So, like, let me explain it to you. When the market is really short, and I could give you like a personal anecdote when I was a floor trader. When I was a floor trader, and for some reason, I don't know why, but all floor traders, or just about all floor traders, I know certainly myself back in the day, and a lot of my friends in the trading pits, either in New York or Chicago, I don't know, we had this penchant to want to sell the market all the time. We always wanted to go short, maybe because the market tended to fall quicker than it went up. I don't know, maybe it's just a psychological thing, but I remember many times when the pit, that means, you know, all the independent traders there trading in the pits, the market, the pit would get short, like everybody was short, and we'd try to pressure it. And, you know, we'd have some success just offering down prices and offering, somebody else steps up to offer, but, you know, you could feel that it was not going because it couldn't. Everybody was short, and then the thing would snap back, and we'd all be competing, you know, against each other to try to buy back our shorts. I looked at today coming into the market, and I saw overnight we were already down, and that didn't surprise me. We weren't down a lot, but given Friday's week close, you know, the worries about this week is the Jackson Hole Symposium. You got the Fed, everybody's worried about interest rates, and I'll talk about rates in a second. You have what happened in Russia with the assassination of that philosopher, that guy Dugin, his daughter, you know, tensions there. So I wasn't surprised that, you know, we started last night weak, but then, you know, we really accelerated down. But I was thinking, like, the market's short. I mean, who's selling? In order to sell, you need longs that have to liquidate. And who's long? I mean, dealers are long, but they're not going to liquidate because they're long against, you know, customer shorts. So they're always hedged one way or another. They're flat. They got to show that to the clearing firm. Institutional asset managers are long, but like a teeny tiny amount. They're selling right now is not going to push the market. I don't think would push the market down as much as it did in the last 2 days. But and you know, the speculators, the big funds, and even the small specs, they're net short, and the combined outstanding shorts of the large specs and the small specs, that's over 1 million contracts, S&P E-mini. So I was thinking, like, we're not going to go down very much because there's nobody around to sell. But down we did go. And I don't have a good explanation for it. I can tell you that fiscal is very good. There's money in the system. We're already up to like a 198 billion deficit for August. That equates to a net addition of 109, almost 200 billion to the financial balances of the economy. Very positive. You know, we're not in that September drain period, which I've been warning about. Okay, that's still, you know, a little less than a month away, a few weeks away. I mean, this might be some selling leading up to that, and I've been saying that that's a possibility, but I just don't see it for today. But it happened nevertheless. Now, we had some developments. You know, we had bond yields pushing back up over the 10-year yield back up over 3%. Everybody's worried about interest rate. That kind of stuff doesn't bother me because, you know, I've explained it already like a million times. I mean, we are really starting to see the whole interest rate rise phenomenon flow through in a big way as a fiscal expansion. I mean, I talked about that on Friday, how interest on Treasury securities is now up year over year. We've had a 20 billion positive swing from the low, the trough, to getting that positive year over year right now. And I didn't even mention that if you look at the T-bill discount, you know, on newly issued bills just for this year, that's an additional 30 billion over last year that has been added because, you know, that's rate hikes. I mean, so we are having a very strong fiscal expansion thanks to the rate hikes. So I let everybody else go nuts about interest rates and freak out and panic. You know, that again, they don't understand. You know, they see one side of the dynamic. They don't see both sides of the dynamic. And the other side is very powerful, what's happening with the fiscal. So there's money in the system. Now, maybe that money was deployed, you know, on the short side. I don't know. There's still evidence of lots of put activity. You know, they're rolling them now into September. We did have, like, if I'm gonna talk about what could be some triggers for this selling, well, we had a big rise in the dollar. I've been telling you about the dollar, and I've been saying that the fact that the U.S. is now not just a net exporter of petroleum, but a significant net exporter of petroleum. In the week ending August 12th, the U.S. was exporting 5 million barrels a day of crude oil. 5 million barrels a day of crude oil. I mean, that's unbelievable. For those of you who have followed me for any length of time, you know that I was bearish on the dollar for a long time, but I never, ever thought that we would see a scenario, a reality, that the U.S. is exporting 5 million barrels a day of crude. You know, that is a policy decision. By the way, this big export trend, you know, that was started under Trump, Biden's just letting it go ballistic. But as long as the U.S. stays a net exporter of petroleum, and also, you know, we've seen a big shrinkage in the deficit year over year. It's down like 1.6 trillion year over year. That narrowing, I talked about this. That's removing dollars from the system. I mean, this is a bullish fundamental situation, and I don't see it going away anytime soon because of the sanctions on Russia and the attempts, you know, successful or half successful, to shut Russia out of the global, as a global energy supplier. The U.S. is stepping in. Now, this has other implications besides just being bullish for the dollar. Number one, it has implications for the U.S. trade and current account deficit. That is going to shrink, and we are starting to see that shrink. That's another bullish fundamental that's happening right now for the dollar. And guess what happens when the trade deficit shrinks? And I think I might have mentioned this in my last video, but if not, here it goes. When the trade deficit shrinks, it then becomes less of a subtraction to GDP. So in effect, what's happening is that the income stays here in the United States rather than being, transferred out to the foreign sector. So that means higher levels of GDP. You're going to see GDP growth forecasts, GDP forecasts are going to be ratcheted up. That's bullish. All this stuff is bullish. See, that's again, when I step back and look at the macro situation on the stock market and the economy, it's definitely bullish. The fiscal flows coming in as a result of rate hikes, the rise in petroleum exports and the shrinkage in the trade deficit. Well, what's that going to do to GDP? It's going to raise it up. It's all bullish stuff. So yeah, I mean, the only thing, not the only thing, okay, so the dollar today, I saw commentary. This is, again, it's like the interest rate analysis that I have given you. What you hear and what you read is only one side of the dynamic, okay, when it comes to interest rates. Everybody's like, oh, interest rates are going up. It's costing more money to finance. They're not talking about the fiscal expansion that is, that comes along with those rate hikes. And it's very, very evident now. It's becoming very, very evident. All right? And the other thing is, like, I was listening or reading today commentary on the dollar, like, oh, what's that going to do for companies that earn in euros? What's that going to do for, all this kind of stuff? Again, that's only looking at one side of the equation. What's that going to do for, income that has previously, remember I always say that income doesn't fly out into outer space, but it does fly out to the foreign sector. Now it stays here domestically. That's profits, that's earnings that stay here domestically. That's the other side of the dynamic that nobody's talking about. So I understand, like, the reaction. I mean, you could read the comments and you can understand why people are freaking. Oh, the dollar's going up, I better sell stocks. I mean, it doesn't make any sense at all. Oh, rates are going up, I better sell stocks. Well, yeah, I understand that. That is something that has been driven home deeply into people's heads. But again, it's only half the equation. So right now, I cannot really put a finger on how come. I mean, I could see why the market was down today based on rate fears. That was the headline everywhere, rate fears, and also the dollar. Okay, so this to me is, it's emotional trading. It's one-sided understanding. The fiscal drain, that is a real source of concern. And I'm going to say it's not even a massive concern, because the corporate tax payment, the quarterly corporate tax payment that's coming in September, that's 120 billion. It's nowhere near what we had in April, 324 billion, followed by another 100 and 120 billion. There was a quarterly corporate tax payment right after that. We're going to get that tax payment. And by the way, I just read today that some states, I think there's something like 8 or 10 states right now that are going to start sending out stimulus checks next month. It's September. States. So they're doing it from, I guess they're flush with with cash. They're going to send it out to help people. So that could offset some of the negative impact from that quarterly corporate tax payment. And then again in November we get another interest payment. But I really want you to try to understand that there's two sides to these dynamics. And you're not getting that picture. Well, you're getting it here. You know, I'm telling it to you. I'm explaining it to you. But out there, when you see the headlines and like, oh my God, interest rates, oh my God, inflation, oh my God, the dollar. That's half the story. And the other half is just as important and impactful, if not even more. All right? So, yeah, today was down big. I still think, and by the way, back in July, early July, I said we were going to hit between 42.50 and 45.20 on the S&P. And I think we got just below, I think we got up to like 43.90. So, but I still think there's some room left in this rally. I think this is a pause. I think the real correction will come in from mid-September to mid-October when we get that liquidity drain. I mean, that's real. This stuff here to me is just like, again, the market, you know, funds are short over 1 million S&P contracts. I just, you know, reflect back on my days in the pit. I mean, we were selling, we were offering, we were trying the best we can to push it down when everybody's short. You need somebody to sell, you know, so your position, you know, goes down as you're hoping. I don't see who's doing the selling. If there's selling happening now, it's being financed. That means it's speculative selling. It's being financed. It's not long liquidation. And, you know, if it's being financed, that just makes it vulnerable to a snapback going back up. Anyway, that's it for today. It's Monday. I sent out the new issue of MMT Trader. If you want that, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial. See you tomorrow. Bye.